featured guest Colin Stewart for a closer look at how Canadian investors should be thinking about and perhaps how they can navigate tariff risks. Colin?
Yeah, so I think as we all know, it's very likely the Trump administration is going to impose fairly onerous tariffs of some percentage amount, maybe 25% as he suggested on Canada as soon as February 1st. And this obviously, if it persists for a long period of time and there are retaliatory tariffs by Canada, which is, I think, highly likely, it could be very damaging to the economy and particularly certain businesses. So, we, like many other investors, are sorting through the different industries and sectors and trying to think about where we want to be positioned and where, what areas we might want to avoid. I mean, I think obviously sectors like the auto parts sector would be highly vulnerable. Companies that produce a lot of goods in Canada ship them across the border. I think if Canadians do own manufacturing type businesses, I think the key is to focus on, do they have physical facilities, manufacturing plants actually located in the U.S.? Do they have employees there, distribution centers? Those businesses will be somewhat more protected because they actually have physical assets in the U.S. and perhaps are producing a lot of their goods there. But the one other way we've sort of identified and thought about as well, if we can find businesses that are highly domestically oriented and really don't have any U.S. revenue or any U.S. business, those might be attractive areas for Canadians to look at. And one such position we own today is a company called Dental Corp. A very simple business. They're the largest owner of dental clinics in Canada. They own about 560 clinics across the country. They've been a consolidator in what is a very fragmented industry in Canada. So they only have about 4% market share, even though they're the largest. And 90% plus of the business is still owned by individual dentists who own one or two clinics. But if you look at the example in other countries like the U.S., for example, about 20 or 25% of the industry is owned by bigger consolidators. There are economies of scale. In Canada, actually, it's a very good business because Canadians have a high propensity to go to the dentist. A large number of Canadians have dental insurance. There's the new dental plan by the federal government that supports lower income Canadians. And, overall, it's a very steady business. The stocks come down a little bit because of an equity issue they did a few months ago, which the market didn't love, but hasn't changed the fundamentals of the business and trades at a pretty attractive multiple of only 9 times EBITDA. So we really like that as sort of a way, a bit of a safe haven place for investors to hide. It's a healthcare oriented, recession resistant, no tariff risk. So that's just one example, I think, of sort of how we're, for our clients, thinking of, well, where do we want to be positioned in this type of an environment?
How does the market value Dental Corp? How do you value it? Is it an earnings per share story, or are there other metrics that are more germane?
Typically, the industry looks at enterprise value to EBITDA or free cash flow, and particularly on a free cash flow basis, which we always like to look at. I mean, this business could do, as close to 80, 90 cents in free cash flow per share in the next couple of years, and it's only trading at $7 and change. So, having a free cash flow yield, as investors refer to, of over 10% relative to your share price is a very attractive metric. So for a business of this quality, for example, in the U.S., there was a U.S. private equity firm that bought the second and third largest players in Canada and put them together, and they paid about 16 times EBITDA, we believe, to buy those two businesses, and Dental Corp is only trading at 9 times. So a really large discount to sort of what private equity players are paying for these companies, not only in Canada, but the U.S. market is also being rolled up. And I think there's a really long runway for growth here because they can continue to acquire clinics as dentists, want better access to technology, and they just want to focus on, being a dentist and not having to manage the business. And that's sort of what Dental Corp offers with technology, and they're even looking at AI solutions to better analyze dental x-rays and things like that, and have a lot of sort of support for the dental clinics that they buy, and obviously, purchasing synergies as well. If they can buy equipment or consumables en masse for all their clinics, they can get it at a lower cost than an individual dentist could for one clinic. So we think the long-term runway for growth is very good. They're going to grow at 10 to 12% this year, and pretty steady, predictable business, and trades at a sort of a depressed valuation in our view.
Any quick thoughts on the Canadian bank stocks in this context?
Yeah, I don't think they're highly vulnerable to tariff risk. I mean, the logical way they might be exposed is if the Canadian economy simply goes into a large recession because of this, persistent tariffs or prolonged period of tariffs, and that's something that many observers and analysts have pointed out. And I think, one way to think about it is positioning in those banks that have a bit more U.S. exposure. BMO would be one that comes to mind, or even TD. Despite their problems, they have a larger U.S. franchise than some of the other banks, and so those companies might benefit if we see a stronger U.S. economy and a bit of a weaker Canadian economy because of the tariff risk. So people have been, talking about perhaps positioning more in those banks with larger U.S. exposure.
That's Colin Stewart. And